Hi, I'm Tom Mihawk, and this is Mutual Funds Basics. I've been recording new, shorter versions of my stocks, bonds, investment fundamentals videos for use by my grad students, my undergrad students, non-degree program students, and others in the public that have an interest in this information, which it should be about everybody, right? The key is where before I had 2 or 3 videos in one section, now it's just one. And this one should be about 10 minutes. It's about mutual funds. Everyone invests in mutual funds, right? By the way, I'll also put the slides in the notes, in the YouTube video in the notes. And so you'll be able to get the slides, print them, or take notes on them, write on them, keep them, whatever you want to do. Okay, mutual fund basics. It's a great chart, great little graphic that shows how mutual funds work. Basically, investors pool their money, they invest in a mutual fund that itself buys stocks or bonds or real estate or whatever and passes those returns back to the investors on a pro rata basis. Meaning, if I invest, if there's $100 million total invested in, and my investment is 10 million, and someone else's is 1, and someone else's is 3. Well, my percentage is 10%, someone else's is 1%, the other person's is 3. So on a pro rata basis. The benefits are it's more affordable, you get more diversification, you have liquidity, I can buy and sell when I want, I don't have to buy and sell my own individual stocks or bonds, for example, and I get professional management, I get someone expert at stocks or bonds or real estate or whatever that makes these investments. This is a great little graphic. You own mutual funds for professional management. You hire someone from Fidelity, Vanguard, Schwab, American Funds, Janus, whatever, BlackRock, who are expert, supposedly, theoretically, and if they're not, no one would buy the fund. So they're expert at their asset class, at what they're buying for the fund. Diversification. For you to buy 100 stocks, for anyone to buy 100 stocks is challenging. You may have certain minimums. You might not be able to buy the amount you want. Well, you can get diversification, and next one down, it's affordable. $1,000, $500, $5,000. Instead of having to pay, a minimum of $1,000 per stock or $500 per stock, to get 100 stocks, you'd have to spend $500,000. With mutual funds, you get diversification and affordability. Fund companies allow you to transfer between funds, do systematic investing, meaning you can sign up on a paycheck to have it sent directly to a mutual fund company, Vanguard, Fidelity, Schwab, whatever. And it automatically goes. And as we know from a behavioral standpoint, what you often what you don't see, you don't miss. So direct investing like that is a great way to go. Liquidity. When you need your money back, you don't have to sell individual stocks or individual bonds. Just sell your shares in the mutual fund and do it when you want. I mean, maybe not outside the market, although even at that, there are some funds you could do that with. But the point is, practically speaking, anytime from a liquidity standpoint. Many types of mutual funds representing all kinds of asset classes, stocks, bonds, tech stocks, value companies, old companies, big companies, small companies, Asian, European, South American, you name it, the fund probably exists for that asset class, that sector, and for various purposes, long, short, savings, income, capital gains, all these different things. And they're audited track records, which is important. Expenses of a fund matter. So at purchase, load funds have a fee when you purchase it, no load funds don't. At purchase and while you own it, there are A, B, and C shares, and they describe the way the purchase price is charged. Some charge it at the beginning, some charge none at the beginning, but charge you a surrender charge if you sell within a certain period of time. No load funds charge none of those. They charge you a fund expense ratio or expense fee. And the expense ratio is a ratio of the total cost of the funds divided by the total fund assets. They vary from, well, some funds are now free, but a large S&P 500 index fund might be 3 basis points, meaning 0.03%, up to maybe an international fund might be 75 basis points, meaning 0.75% or 0.75%. And there are others that are greater than that. But the lower, as we've said in these previous short videos, the lower the expense you pay, the better your chance of having a high net return, and that's what you want. Expenses matter. How do we make money? When the share price or the net asset value goes up. The net asset value, there are two kinds of mutual funds, right? Two general categories. There are many, many kinds, but two general structures. The first is an open-end fund. I take my money, I take your money, I take all the other people's money who watches the video, pool it together, buy assets, divide it by our pro rata percentage ownership, and that's called, divided by a per share ownership, and that's called the net asset value. When the assets underlying that we've purchased go up in value, the net asset value goes up. And so if you own 10%, if there are 100 shares outstanding, you would own 10 shares, right? That's your net asset value. The net asset value changes based on currency exchanges, if they're foreign investments, changes based on interest rate changes, if they're bond funds, and also increases and decreases in share prices of the underlying stocks or bonds or whatever you own. Dividends and income that go into the fund also affect the share price or the net asset value. Selling shares when the share price is increased creates a capital gain. Now, you need to know that within a fund itself, the portfolio manager is buying and selling securities. When they sell securities, it creates a capital gain. The capital gain is accumulated, tabulated, recorded, and by the end of the year, everybody who owns a share in that mutual fund gets a pro rata share of the capital gains generated, which is why some people like very low turnover. Turnover is how often a share in the portfolio in the mutual fund is sold. And so a fund that has 100 shares at the beginning of the year and 100 at the end, no sales, has zero turnover. A portfolio that has 100 shares at the beginning, 100 shares at the end, but they've all been sold and rebought, that's 100% turnover. Turnover creates capital gains when the shares sold have been sold for a profit. There's also income and dividends, and those are distributed. The capital gains are distributed, as I just described, on a pro rata basis. Capital gains are just the taxes. Capital gains are distributed so that everyone pays a fair amount of taxes. Capital gains are distributed on a pro rata basis. Everyone receives, if the portfolio has 100 capital gains of $100 and your ownership is $10, you're going to get 10% of that $100, or 10. You're going to show $10 of capital gains. Costs are important, very important, but net returns matter too. Gross fund returns less operating expenses equal net returns. If you find a fund with high costs that produce consistent or exceptional net returns, they'll consider them. So index funds, passive managers generally have lower fees. We've talked in previous videos about beta. They're managing generally beta. They're producing a market return, right? But if you have in your, say, 401k plan or at your fund company where you have your IRA based, you have a choice of an active manager that on a consistent basis has produced exceptional returns such that they're greater, the net return is greater than others that have lower fees. Use it. It's not a moral or ethical issue of using a fund with higher expenses. What matters is the gross return less those expenses. That's what counts. On average, passive managed index funds produce better net returns because they have lower expenses, but there are certainly actively managed funds that on a net basis do very well too. If you need a fund in a certain asset class for diversification and its costs are higher, it may be more beneficial to have a diversifying effect despite the higher costs. Another reason for choosing a higher cost fund. A bias for lower costs, though, produces better returns over time for the average investor, meaning get the market return. Keep your costs low. On average, that's the best way to do it. excuse me, investment objectives, large, mid, small cap companies, various industries like technology, pharmaceuticals, manufacturing, international index funds like the S&P 500 or the Wilshire 5000, asset allocation funds that do some large cap companies, some small cap, some mid cap, for example, and balance that own both stocks and bonds. Long and short positions, selling first. A long position is where you buy first low and sell later high. That's where you want to when you're long. When you're short, you're borrowing first high and selling later low. And there are big differences actually. We could do a whole chapter on long and short. Most mutual funds invest long. It's considered simpler, more conservative. Many believe it's more likely for security prices to go down with bad news than up with good news. And so people sometimes think that it's easier for people to speak poorly of a stock and push its price down than it is for good news to push it up. We've talked a little bit about active and managed funds and how they, we've talked a bunch about this. Active funds attempt to beat the market. You should pay a little bit more for actively managed funds. Passive funds attempt to recreate the market. Their beta is around 1. It does what the market does. You shouldn't pay much for it. Portfolio manager, we just talked about a few slides ago. Portfolio turnover, yeah, a few slides ago. ESG funds are popular these days. Environmental, social, and governance. They look at these aspects of fund investments and allow buyers of funds to make choices based on how the investments are selected relative to these criteria. Target date funds are very popular, very good choices for retirement for younger people. They change over time so that they become less risky and have less investment concentrated in stocks. For a young person, 22, 25 years old, 30 maybe, you might have all or nearly all your retirement savings invested in stocks. But you want to change that as you get older to dampen the effect of the volatility of the stocks with things like money markets or bonds or real estate or other diversifying elements in a portfolio. You can evaluate mutual funds using services like Morningstar or at the fund company. You can read the prospectus. Wall Street Journal, New York Times, other publications will help you. Measuring performance. Look at historic returns for 1, 3, 5, and 10 years or since inception. That's generally what's published. Now, I'm going to go out on a limb and say that even though the industry tells you to always say past performance is no reflection on the future, and that's true, I agree. But when you hire someone, you look at their resume, you look at their background, you don't know what they're going to do in the future. You don't know if they're going to get divorced or have a parent get sick or who knows. They may not perform as well as their past said. In many cases, I would say a great starting point is to look at how the fund has done in the past. The 1 year, the 3 year, the 5 year returns, the 10. Each of those say something different. But the point is that if the manager hasn't changed, if the fund strategy hasn't changed, what it did in the past is a likely indication of what it might do in the future. It's no guarantee, but it's a likely indication of what might happen in the future. How to choose a fund. Determine your time frame, review from previous videos, from the investment fundamentals chapter, the investing plan and how should I invest. Look at historical returns, look at volatility, the maximum drawdown. All these things matter. Consider costs, consider the tax implications of the fund, and consider its diversifying opportunity and how diversified it is relative to other things you already own. This has been Mutual Funds Basics. Thanks for watching. I'm Tom Mihawk, and these are the short form of some of the longer videos that I've done. Mutual Fund Basics. Thank you.